Hey man, what's up?
Living it up. What about you?
About the same, man. Just making it through this market. Um, Once again, we have matching outfits on today. You got your ATL mortgage shirt on. I have my Atlanta's finest 5K shirt from this weekend.
And you did beat your personal best this weekend by
I
what?
did.
30 seconds or a minute? What was it?
It was by 90 seconds, actually.
Oh, okay. Well, I was
90
way off.
seconds.
Sorry.
That was
I feel like I just disrespected you. I'm sorry.
no. I appreciate you paying attention to that. I'm proud of it for sure.
That's great.
Are you going to run the 9/11 Heroes 5K with me? I'm putting you on the spot here live.
I should. I need to run something. But yeah, you know what? What is it? I'm guessing it is on
It's
Sunday.
September. It's the 10th. It's
Okay, so
September 10th.
Saturday the 10th, not Sunday the 11th.
Yeah, and it's at 10 a.m. So it's actually kind of a later
Where's
start.
it at?
Basically, the same place this one was, like Centennial Olympic area, running through downtown to midtown.
Okay.
Yeah.
And it seems like you cruise through pretty fast.
I mean, literally, it only in my pace is pretty slow, honestly. Very slow. I'm on like the middle to lower range of men my age. You'd probably do it a lot faster, but my pace is pretty easy to get through there, and it only takes about 30 minutes. So you can do it. You said you'd never run one, right?
No, I'm not much of a.
You
I,
do run though, don't you?
not a whole lot.
Okay.
I do like sprints and stuff, like when I'm working out or whatever, but nothing long distance.
Yeah. Well, that's pretty easy, and you get a free T-shirt.
I
So
probably go for the free T-shirt since I
yeah, I mean,
feel
you have to
like
pay to sign up, but you get a free T-shirt, and then you can show off to everybody that you ran a 5K. So that's what I do it for. But the 9/11 one, I'm excited about that one. It's a good cause. This weekend was in sponsoring Crime Stoppers, so that was a good one. That's the reason why it was a lot of Atlanta, APD, Atlanta Police Department there, and there were some academy recruits there running, so it was a good cause. But anyway, we're here for State of the Market, and we're talking about the Atlanta real estate market. Ben, you're up on this one, man. This is your episode right here. This is your episode because we're talking about loans, mortgage options. Most buyers, we're talking about conventional FHA and VA. Most buyers, typical buyers, unless you're a veteran or active duty, you're looking at either a conventional or FHA, or if you're in rural areas, you're looking at maybe a USDA, but we're just going to stick to those three.
Cool.
Conventional, FHA, and VA. And the reason why I wanted to talk about that, the main reason is a lot of people may not know what the differences are, what the pros and cons. You did a video this week about the cost of a 3% conventional versus FHA 3.5% down. And so, I didn't realize that there was a cost difference to the buyer there. I guess I take that back. I did know, the private mortgage insurance is expensive, and then you've got the 1 3/4 is what it is, right?
Yeah. So like on FHA, if you're going FHA, they charge 1.75% up front. That's financed into the loan amount. So really, a lot of buyers, and that's where like somebody like myself has to come in and educate these guys. Like, okay, here's an FHA mortgage. Okay, every month you're going to be paying 0.85% as a mortgage insurance premium monthly. But then FHA also has 1.75 that's financed into the loan amount that you don't see. It just increases your loan amount. So really, it takes away equity. It takes you longer to gain equity, right? Because you just finance another almost 2% into your loan amount that goes to FHA, Ginnie Mae, to pretty much, it covers them for foreclosures and other mishaps that happen on the FHA side, especially in that lower credit bucket where you might see some more foreclosures, bankruptcies, people who just don't pay their mortgage. Which I know that kind of sounds funny, like people don't pay their mortgage, but like I remember even last year, I had somebody I closed a mortgage for, and they never made a payment.
Wait, what now? How long had they had that loan?
The thing is, they never made a payment.
Okay, at all. Never made a payment in the life of the loan?
Nope. And then straight into foreclosure. So they closed on the house. So let's say they closed in June. Your first mortgage payment is going to be due August 1st, right?
Mm-hmm.
They just never made a payment. So then it goes into foreclosure proceedings, and that takes forever. So like, I think they just got out of the house,
Mm-hmm.
but they just wrecked their credit, and they're pretty much never going to buy another home. They're not going to buy another home for another 4 years or 7 years, depending on what route you go. So it's a really muddy situation. So that's what a lot of that 1.75% unfortunately goes to, is to protect the government on these FHA mortgages.
I mean, the good thing is we don't hear a lot of situations like
No.
that. I have never run
Yeah.
into it. I mean, you would hear about them before I do, but I've never heard of a situation
And you
like
don't.
that.
And the thing is, and unfortunately I didn't hear why it happened. I don't know if it was it could have been a multiple things, right? Loss of job, somebody got sick, whatever it was. Unfortunately, at that point, it's out of my hands. I didn't find out why. I did reach out to the buyer who bought the home because I actually really liked them and I cared for them, and I did reach out to them, but I never heard back from them. So I don't know what happened, and I really do wish I did, but it's kind of that's a one-off deal. But I'm just saying that's what that 1.75 pretty much goes to protect, right?
Yeah. Okay. Well, yeah, that makes sense. I did not. In doing an FHA contingency, I always check off that add into
Yeah,
finance into mortgage, and that's actually an option on the contingency. So have you ever had any where the buyer pays that 1.75 up front?
No, let's just call it as it is. A lot of those buyers don't have that extra money to go ahead and pay that premium up front.
Mm-hmm. Yeah.
Most of the time we're scraping together the 3.5% down.
So I've got a lot of questions for you in this episode, but
Sure.
First, let's start off with that topic that you had on your video this week, which is what are the benefits to going 3% conventional versus an FHA loan, which is 3.5% down, and what is going to stop a buyer from being able to do that, to go that route?
So let's just start with conventional 3 versus FHA 3.5% down. The obvious is 0.5% less in down payment, right? So that's a win for conventional 3. Okay. With conventional 3, you do not have to pay the 1.75% upfront mortgage insurance premium. If your credit score, and this is where the only time it really makes sense to go conventional 3, depending on the pricing, you pretty much have to have a credit score of 680 or higher for it to really make sense. Because at that point, because on the mortgage for PMI on the conventional side, the mortgage insurance, private mortgage insurance, it's based on your credit score and it's risk-based pricing. So the lower the credit score, the higher the premium. Okay. So once you get really mapping these things out, once you get below 680, it really doesn't make sense for you to go conventional 3 because your monthly payment's going to be higher because of the mortgage insurance is going to be higher.
Okay. And could you get approved for a conventional loan with a credit score less than 680?
You can.
Oh, you can. Okay.
Yeah, I'm doing one right now, but they're putting 20% down.
Okay. I thought that was the mark. I thought it was like 680 was the limit.
You can run it. You just have to get it approved eligible. Meaning, like, we can't do a manual underwrite on a conventional mortgage. We have to run it through the automated underwriting system. We get it approved eligible. We've done the lowest 640, 630 with people putting 20% down, have a lot of equity, have reserves in the bank. So like they're looking at, okay, after Tyler puts 20% down, he still has another 20 grand in the bank for emergencies. So that means he might have 20 months of reserves. Okay. So that's where they're looking at the whole picture.
Gotcha.
Reserves. what kind of derogatory credit have you had in the last 12 months? How long have you been on your job? Like, are you job hopping? Like, it reads that, right? Because we have to put in the exact dates. So there's a lot of factors that can strengthen your profile to go conventional. But again, if you're doing the low down payment, 3-5%, if you don't have a credit score, let's say north of that 680 point, yeah, it's going to make more sense financially to go FHA
Okay, gotcha. Because so
because of the mortgage insurance.
because of the mortgage insurance. So if you go FHA, you're going to pay PMI either way, or I mean, you're going to pay PMI either way because of how much you're putting down,
Right.
correct?
Yep.
But on FHA, they're not going to charge you more PMI based on your credit score.
Nope. It's 0.85 for everybody, unless you put a certain percentage down, it goes to 0.8.
Okay. So even if you put 20% down on an FHA, every device is ringing.
Seriously. So yes, even if you put 20% down, let's say you had a 600 credit score and we had to go FHA, but you wanted to put that much money down, you could, but there is still mortgage insurance.
So yeah, so even if you put 20% down, you're still going to be paying 1.8. It's not going down below 1.8.
No, 1.75. But no, excuse me. You're still going to, if you go FHA, you're still having to pay that 1.75 no matter what down payment percentage. Okay.
Mm-hmm.
The monthly amount goes from 0.85 to 0.8. And once you do put that down, that mortgage insurance can actually go away like conventional. But if you only put the 3.5% down and you're paying that 0.85%, that mortgage insurance never goes away until you refinance. On conventional, it actually falls off once you can request for it to be removed at 80% loan to value. It automatically falls off at 78% loan to value.
Okay.
But let's be real. The person putting 3% down, conventional, they're not going to be in that home by the time that PMI falls off.
Really?
No, not at all. I mean, unless it's their forever home.
Well, because what I was thinking,
it's going to take 10 plus years. And the average American these years, they're moving every 5 to 7 years now.
So somebody, how about this example? Somebody that purchased a home that, in 2015 that appreciated, immensely into 2020 and 2021.
That's a great. Yep, we did do that.
Okay. So their PMI would have fallen off, right? I mean,
so when we refinanced them, their PMI, because they were at 80% loan to value because of the appreciation, right?
Mm-hmm.
But it wouldn't have automatically fallen off based on appreciation. It's not like the servicer is going to do an appraisal for you and just remove the PMI.
Okay.
You'd have to refinance to get rid of PMI based on appreciation.
Based on appreciation.
Yeah.
Okay. So where other than that loan to value being based on appreciation, what else is it based on?
Based off principal payments paying it down.
Oh, gotcha. Oh, yeah. Okay. Okay,
so
that makes sense.
So whatever payment of principal going towards your loan amount every month, that's what dwindles it down to that 80% loan to value. That's why it's like, am I ever going to get there? Like, it's going to take 10 or 15 years to
makes total sense. That makes total sense. I didn't realize that until now. So that's good. I was thinking that, yeah, once your home appreciates to where it's worth, where with the appreciation, it's worth enough to balance out that loan to value.
You would have to refinance at that point. Or there has been some cases where you might be able to call the servicer to do an appraisal or something like that. But then again, that's few and far between. It's most likely going to be a refi.
Gotcha. Okay. Very cool. Well, that's definitely good to know. What about, okay, you've got a veteran buyer and they're looking to buy in a competitive area and they can use a VA loan versus a conventional loan, knowing that a VA loan, unfortunately, isn't as competitive in the market as a conventional loan. what do you recommend to that veteran who's looking to buy based on those two options?
Unfortunately, VA kind of has a bad rap because some of the listing agents and just agents in general, they don't understand VA lending, and they don't understand it's like, number one, it's a phenomenal loan program. And I kind of go a step above, and I'll call that listing agent. So let's say Tyler's putting in an offer for a veteran. I'm calling that listing agent and say, hey, they're going VA. You have nothing to worry about. All said and done. They get so tied up on the appraisal, right? Like, oh, they're going to require us to do all these repairs. And, well, no, they're really not. Like, if the house is in good shape, it's going to be fine. Like, if there's things that aren't working, yeah, maybe you should fix them. There's going to be some things that VAs are going to require because they want to make sure that they're putting their veteran, into a stable house.
Right. And I mean, that's
falling apart.
Right. And I'm glad you said the thing about calling, because I was going to ask, like, what can you do, or what can the buyer's agent do to make that seller and that listing agent feel more comfortable with going with that VA loan over conventional loan offer?
It's just educating the agents. I mean, and maybe I need to do a better job in Metro Atlanta on educating agents on VA on why it's actually a phenomenal program. And they think just because the veteran's not putting down any money, like they're not credit worthy. I closed on a $1.4 million VA deal. He didn't put his penny down.
But he had a great credit score.
Great credit score, cash. Well, why? Maybe he didn't want to sink his cash into the house. He wanted to use his benefit.
Mm-hmm.
It's a benefit. That's what people need to understand. It's like, it's a benefit. Like, these people like deserve VA mortgages. They literally, they protected us for however many years, right, to earn this benefit to get a VA mortgage, and people need to respect that.
Yeah,
and that's where, like, I get so mad, and I'm getting irritated right now just because, like, people, like, they think that, like, VAs, like, because they're going VA because they're not credit worthy. I'm like, this veteran that we just closed has, probably a better credit score than you and 10 times the cash you do. So don't disrespect that veteran,
Well, I'm going to use a VA loan as, on the next one. We haven't used it yet. I'm going to use it on the next one. Tell me some of the benefits are, other than, it's zero or zero down, right? Which is one of the benefits. So, but, most people still want to put something down to affect their monthly payment, right? It's zero down. So what are the other?
Substantial. It has to be pretty substantial down payment to really make it worth it, right? Because, like, you got to think a 30-year VA mortgage is spread out over 360 months, right? So let's say you want to put down $50,000. Okay. If you divide that by 360, that's only $138 a month.
Mm-hmm.
So would you rather pay $138 more a month in your monthly payment, or keep $50,000 in the bank?
Yeah.
So that's something that I ask everybody, is like, especially and it's been more and more popular the past couple of years, because, like, you know what? I think I would rather have money in the bank than put money down, just in case.
Right.
Just in case there is another pandemic, just in case I lose my job, whatever it is. Because guess what? It's really hard to get money out of your home unless you're doing a cash out refi, HELOC, something like that. And it's really hard if you don't have a job. So that's why, I would keep the money in the bank, to be honest with you.
So tell me, a couple other bonuses to, if you're a veteran using a VA loan, what are a couple other pluses to using the VA loan over a conventional?
Better interest rate than conventional all day long. There's no monthly mortgage insurance like like FHA or conventional or USDA. There is a funding fee. So veterans do have to pay a funding fee unless you're a certain percentage disabled, and then you're what they call exempt, and you do not have to pay a funding fee. I can't remember off the top of my head what that percentage of disability is from the VA to get that exemption. I want to say 70 or higher, but that could be, I would have to look it up. But there's a certain percentage of disability from the VA that you don't have to pay a funding fee. That funding fee that I'm talking about is financed into the loan amount. So you're not paying it at closing either. It's financed into the loan amount.
Okay. Very cool. Well, that's good to know.
It's definitely the way to go. And it's the most lenient. It's the most lenient on credit. It's the most lenient on debt to income ratio. People don't understand about VA appraisals. VA appraisal, you get Tidewater, meaning if the VA appraiser knows that this thing's going to come in short, or they think it's going to come in short, they will call me, they will call Tyler and say, hey, can you provide me comps that you came up to get this price? That doesn't happen on that doesn't happen on conventional or FHA. This turned in the report short, right? So on VA, you actually have a chance to prove your case that, hey, this thing should appraise for 400,000. And then if the agent is so diehard that we had a bad report from the VA, we can then issue a rebuttal to the VA for them to review it and provide those comps, and they'll do their own analysis. So on VA, you actually have two chances to change value, where on conventional and FHA, you really only have one if you do submit a rebuttal to the appraisal management company.
They rarely ever accept those, right?
Well, I think Will and I had one last year that did come up a little bit. No, we actually ended up ordering a brand new appraisal. But anyways.
Well, as far as the Tidewater thing goes, I've experienced that twice. And, in my years of doing real estate, I've only handled, a handful of VA loans on the buyer and seller side. In at least two situations, they issued Tidewater, which in my opinion, or to me, seems like that VA appraiser almost doesn't want to do the work themselves. They just want to go, I can't find it, so you guys tell me what it's worth.
That could be the case. And it's almost like, it's almost like the case where even now, or even the past 2 years, even appraisers have gotten lazy with, appraisals come in and write at contract price.
Mm-hmm.
That
happens a lot.
Contract price, but so you're not saying it's not worth 5,000, 10,000 more. Like, I mean, how much work did you really do on this thing? I don't really know, but it's just kind of funny that you get 3 comps, which is the minimum, and it comes in at contract price.
Mm-hmm.
Like, I just think that, there's some people out there, luckily on the conventional and FHA side, that we have a really good panel of appraisers that we.
Yeah, nothing against appraisers. I love appraisers. I love all appraisers. Nothing against appraisers. I just was mentioning the Tidewater thing.
Yeah. But, Tidewater, of course, is just a totally different rodeo in general. But I think it's great. I mean, they're giving you an opportunity to, prove your case, which is good.
Yeah, I mean, like I said, I've had that happen twice. And then
did they come in contract price?
Huh? No, not on this one. It didn't happen on this one. It happened actually not. It was part of the daisy chain. It was the buyer that was purchasing my listing. They were selling their house, and then it was Tidewater issued on that one. So, but yeah, I mean, that's one of the reasons I wanted to talk about this week, is because of that listing I had, or that I have right now that's under contract. And, we had the multiple offers. We didn't get anything conventional. We got FHA and 2 VA. And I mean, in my experience, appraisals can be somewhat subjective, right, based on the appraiser that comes through, and what their what they see, and sort of their opinion of it to a certain extent, right? And so that's what I kind of had to tell the seller is, these are the risks with some of the things, because this house had some problems. And so this is the risk with that. And it's basically just going to be up to the appraiser.
Right. And that could happen on any loan, right? Because if that appraiser comes in there and it's like, maybe they're having a bad day. Heck, I don't know, but maybe they flag something for repair or whatever that really doesn't really need to you just don't really know what you're going to get. From that appraiser on that day.
Yeah, it's true. Yeah. And, with things changing right now, I haven't seen it yet, but I wonder if appraisers are going to start getting kind of shaky on their appraisals with things slowing down right now. I don't know. I mean, at a certain point, it kind of has to start. I mean, not going the other way, just like kind of balancing out and not just keeping going, going straight up. But I mean, I had a great weekend last weekend with that listing. Honestly, it was great. I mean, we positioned it properly, which was the main thing. But we had, I think, 15 showings. We got 3 offers. Like I said, 1 FHA and 1 VA. And then since then, I've had other agents call me and say, do you have backup offers? And, we had a really good weekend with it. So that's like proof right there that there's still buyers in the market. People are still out there home shopping right now. And Atlanta is one of those places, we talked about this before. Atlanta is one of those places that's just like not going to slow down anytime soon, or not completely come to a halt, just because so many people want to move here. There's so many businesses here.
Film industry and everything else, like booming.
Yep. So I don't have anything else, man. I appreciate you giving us the rundown on VA and FHA and conventional. And I agree. VA is a great program. It is a benefit. When we joined up first, one of the first things that they talked to us about, the recruiter talked to us about, was that VA loan. And I was 18 when I joined, and I had no idea what he was talking about. But I was like, I get to use that.
Now you're selling real estate.
Yeah, exactly.
You're selling real estate. You need to call that cat up and say, hey, I really appreciate you telling me about that VA mortgage. Now I'm in real estate. So,
man, I don't even remember that guy's name. That was so long ago. I don't remember what he looks like. I don't, have any idea. But yeah.
I absolutely love VA mortgages. And I just think it just comes down to education and learning the ins and outs of VA mortgages. And people need to change their mindset that it's not, yes, it's a mortgage, but it's also a benefit. And, I'm not saying that you should take every single VA offer that comes in. I know that's not realistic, but because you could actually have a better offer at something else. Maybe it's a higher, maybe somebody offered over. But if you have personally, if the loan officer did their job, there is no difference between conventional 20% down and VA.
Yeah.
If the loan officer did their job and you have a credit-worthy veteran, at that point, it's up to the seller to decide, and the listing agent needs to educate the seller on VA mortgages as well. It really helps when the seller's a veteran, because I have had that, and they're like, yeah, we're going with the veteran.
Yeah, absolutely.
You know what I'm saying? Like, it's like, as he should.
Right. Well, here's a question for you then on that, 20% down conventional versus VA. The VA loan that we have right now, the offer that we have right now, the veteran is putting down 20% on their VA loan. What, we talked about some of those benefits, but what is the benefit to them using that VA loan and putting down 20%?
I have no idea. I don't know why he would. Unless it could come down to payment. Maybe he wants his payment at a certain dollar amount. Maybe he's buying up the funding fee. There's all kinds of different cases on that.
The interest rates are better, right? You mentioned the interest rates on the
better on VA. Yes, they are a lot better than conventional.
Yeah. Well, you're right. So it's a benefit, and that's the big lesson there for all listing agents. If you receive a VA offer, it's not because this person, it's not because this veteran, has bad credit or anything like that. It's because as soon as they joined the military, and I can speak from experience, that was one of the benefits that was offered to them. Hey, join the Navy, join the Army, the Marines, and you'll get a 0% down payment mortgage when you get out. So that they're just using
just make sure you are honorably discharged and you have a really clean DD 214. We're good. We'll do everything else. So
right. I haven't used my VA mortgage yet. And eventually I will, but that's one of those things, like, I want to use it. It's a benefit. It was offered to me, so I want to use that.
Yeah, and you have your entitlement there. You can actually get two VA mortgages at the same time. Like you could get a VA mortgage and live there for a couple of years, and if the depending on the loan amount and how much entitlement you have, you can actually keep that home as an investment property and go get another VA mortgage on another home.
Oh, wow. I didn't realize that.
Yeah, yeah. It all comes down to entitlement, how much entitlement you have, and how much entitlement was used on that first house. But there's a calculation that we have to worksheet that we have to fill out and turn in. But
Oh, wow. I didn't realize that. That's really cool.
yep.
Well, we hit our 30-minute mark and we got a couple people watching. So thanks for joining us, everybody. And we got a like up there on the screen too. Yeah. So
We're becoming big time.
I know, right? We'll just keep doing this. I think probably about 50 more episodes and we'll have have a good following.
Yeah, I mean, we're gonna like maybe Spotify reach out, give us a contract or something.
That's the dream.
No,
not really. The dream is only to educate Atlanta buyers. I mean, buyers everywhere, but buyers and sellers everywhere. But that's the goal of this, is just to educate and to give people an opportunity to come on here and comment. Once we get off here, I'm going to go over here and fix this and make sure that there isn't an issue with commenting. But if anybody wants to send us a question or comment on it live during the show, we can answer those questions. Like if you were a veteran and you wanted to ask about, a question about what we talked about today, we can answer those. And please leave comments afterwards. I'm happy to answer. Ben's happy to answer those questions.
Yeah, I mean, Tyler tags me and all this stuff, so I see all the posts. So
yeah. All right, guys. Well, thanks, man. Thanks, Ben. Have a good rest of your week.
See you, dude.
Later.